Hello everyone, my name is Nathan Winklepleck. I am a chartered financial analyst, a full-time investment analyst for a registered investment advisory firm, and I'm the author of the book Dividend Growth Machine. In today's video, we're going to take a look at the Dow Jones 30, and I'm going to rank those 30 stocks by my coffee can scorecard, which is a combined scoring of 17 different financial metrics, each scoring between 0 and 2. And these metrics are designed to identify companies that have a wide economic moat and are likely to be good long-term investments. And I mean long-term investments as in a decade or more, which is my criteria for holding a coffee can stock.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
This is the actual PDF packet that I look at whenever I'm trying to decide whether or not to buy a particular stock. It's a screening tool for me. I don't necessarily use it to make investment decisions purely, and I certainly don't recommend that you do that either. This is just simply the start of your research. It should not be the end of it. So I will post the PDF of this entire packet to Patreon and YouTube supporters. I'll also post the entire S&P 500, ranked top to bottom, all 500 stocks. But if I made a video on that, it would take forever. In this video, we're just gonna look at the Dow Jones 30. If you're interested in the entire S&P 500, I'll put a link in the description down below for how you can access that. The scores change monthly, so I do plan to update this at the beginning or roughly the beginning of every month. So if you are a Patreon or YouTube member, you can look for that around the first week of each month. Number 30 out of 30, so the worst scoring stock is Intel. It gets an overall score of 24 out of 100. And that's probably why this one's getting replaced in the Dow by NVIDIA. When I was recording this video, I had the old Dow Jones 30. I don't know why I didn't just use the new Dow Jones and rank them all. So not always the brightest bulb in the shed, but I thought go ahead and include the rankings for NVIDIA here since it is replacing Intel. It scores overall an 82, which as you'll see later in the ranking, would put it in the top 5. So very strong score from NVIDIA here. Obviously a very nice, strong upward trend in earnings and in price. It also has been paying a dividend for quite some time. It's a pretty small dividend yield, but it has paid a dividend since 2013, which you can tell by these green bars. And if we look down at the scores, there's virtually nothing to complain about. Lots and lots and lots of green. Just look at these return on equity and return on invested capital numbers over 100%, which is absurd. Their gross profitability ratio is 89. That's the highest by far that I have seen. I talk about Walmart later in this video, and I was impressed with them. But wow, 89, that is probably the highest in the entire S&P 500. So when you hear people say that NVIDIA is in a bubble or this is like tech bubble 2.0, I don't think so. I mean, this company has numbers to back up their insane stock performance. Just an unbelievable company. The next stock on the list and ranked number 29 is Boeing. And this one is remaining in the Dow Jones, but we can look down here and see why the stock scores so poorly. I've got all of the historical data for Boeing, not all of it, but all the relevant data that I think is very important to making a stock screening decision right here in this handy chart going back to 2001. And I've color-coded it so that anything is green is considered very good, anything that is red is considered very bad, and anything that is black is considered okay. Not all of these are included in the scoring system, but it just quickly highlights to you what is the most important and pertinent information. And the biggest obvious red flag for Boeing is when you look here at earnings per share. So going back to 2019, earnings per share have been negative, and that's denoted by the red earnings. So they've been red for 5 years, and over the last 12 months, it's gotten even worse. Next, we have Dow, which is also getting replaced by Sherwin-Williams. It comes in at number 28. And replacing Dow is Sherwin-Williams. It gets the same score as NVIDIA, actually, with an overall 82. I point out McDonald's later in the video, but I'm going to point this one out first. What you want to see, really, this is almost ideal. You want to see a steady upward trend in earnings per share, which is the blue bars. That is steadily going up over time. You want to see simultaneously a steady uptrend in price, which is these line. You can see that also. And a steadily increasing dividend is also nice to see. That is very clear. So Sherwin-Williams, in terms of just consistency, one of the very best stocks available for that. This is exactly the kind of chart that you want to see. And the numbers are also very impressive. Lots of green, very little red. So overall, very, very, very elite business, in my opinion, Sherwin-Williams. Something that I would not be afraid to hold for a very long time. This would also be in the top 5 if I were to have actually had a brain and used the new Dow Jones instead of the old. At number 27, we have Verizon. What I'll point out on Verizon is that their dividend per share, which I've got here as the green bar, is now above the blue line, which represents earnings per share. In other words, the current earnings do not support Verizon's dividend. That is obviously not a sustainable scenario. And I've got that shown here in the payout ratio section. You can see that the payout ratio was in the red in 2023, and in the trailing 12 months, it's gotten to over 100%. However, one thing to keep in mind whenever you're looking at a company is that earnings and cash flow are not always the same. So if we look here at Verizon, the earnings per share at $2.32 are significantly lower than they report free cash flow at $4.39. So overall, I would say the dividend is not likely to be in jeopardy. Free cash flow is generally the metric I would prefer, but overall, the stock does not score particularly well in the other metrics. It does get a 41 out of 100 though, so it's not an absolutely terrible stock, and that's one thing to keep in mind about the Dow. Most of these companies are very high quality industrial leaders, so even though they score very poorly relative to the other names, they're still likely to be relatively high quality stocks. Next on the list we have Goldman Sachs. Now, one thing the coffee can scorecard does not do very well is assess financials, specifically banks. And the main reason for that is the preferred stock. So anytime you have preferred stock on a balance sheet, that generally indicates that they're either a financial or they're a low quality business. Businesses are not able to deduct interest expense from preferred stock like they are with bonds, and the preferred stock tends to be higher coupons, so it's basically a very costly form of capital. So anytime a company has preferred stock on the balance sheet, that is generally not a good sign. However, most financials will have that, so this is kind of an unfair penalty for Goldman Sachs. They also don't score particularly well in the other traditional metrics like asset turnover. Their balance sheets are just a lot different than the average company. So I wouldn't view this as an indictment on Goldman Sachs. I think this is a fine organization, and I particularly really like their CEO. At number 25, we have the much maligned Disney Corporation. You can see that their earnings per share have absolutely collapsed. So has their price. And how I like to look at these charts is, generally speaking, what you want to see is an upward trend in earnings and dividends over time, also corresponding to general price growth. Anytime you see both price and earnings fall and dividends like you see with Disney, that's a sign that they are coming into some real financial difficulties. The market price is going down, but the fundamentals are also going down. So these can be a little bit of a value trap. And we can see that in their numbers, most specifically with returns on invested capital. At their peak, Disney earned 16% returns on capital and 25% returns on equity. Both of those would be excellent scores. However, in recent years, that has dropped to 3% returns on capital and 4% returns on equity, or 4.5%. At number 24, we have the Coca-Cola Corporation, and you may be surprised to see this one score so poorly, but again, I would reiterate, this scores 53 out of 100, which suggests this is actually an above average company. Again, the Dow Jones is just a very high quality index. It's been around since the 1800s, so I wouldn't necessarily steer away from Coke just because it's one of the lower scoring stocks on the list. The biggest penalty for Coca-Cola is in their growth rate. In future iterations of this, I'm going to add growth rate for free cash flow, earnings, dividends, etc. onto this sheet directly. I haven't done that on this particular version, but I will update this over time and hopefully make it better. But you can see that the earnings per share have started to flatten out, really. It's just becoming more of a slow growth, stalwart company. It's been that for a long time, and that's just what it's going to remain. So a very high quality but slow growing company. And the coffee can scorecard generally rewards growth. Next, we have Chevron Corp, also scoring 53 out of 100. When we take a look at its numbers, one thing I would point out is the general erratic nature of Chevron and just energy companies in general. I like to look for companies where the free cash flow, earnings, and what I've got calculated here, owner's earnings per share, which is Buffett's metric, his actual custom calculation. This is just an approximation of owner's earnings based on Bruce Greenwald's book. But anytime you see a bunch of negatives interspersed with positives, that signals a volatile business, which energy is just by nature of the commodity prices. And you can see that in the both price chart and the earnings over time. So the blue bar and the black line, which is price, are just up and down, up and down, up and down all around, which is not something I like in a long-term coffee can holding. If comparing the two stocks, you can see they both score the same, Coca-Cola and Chevron, but Coca-Cola has a much more of a nice, even trajectory. It does have some ups and downs, but much more consistent than Chevron. Next, we have JP Morgan Chase, scores a 54, and that's pretty impressive since just like Goldman Sachs, this also has preferred stocks, and it also has very poor asset turnover just because of the way that the financials are scored. So overall, I would say a 54 out of 100 for a financial is very impressive. I do hope to make some changes to this to where it will automatically consider if a stock is a financial and maybe have different scoring mechanism for this one, but that's to come in a future update. Next, we have IBM. This used to be an absolute juggernaut, as you can see by the steadily growing earnings over time, but as is well documented, they ran into some problems, fell behind technology, and just, I think, made a lot of poor investments, a lot of poor buybacks. But in recent years, it's really started to make a turnaround. I think their CEO is doing a great job, but it's going to score relatively poorly just because of those poor decisions, still have a consequence, namely their payout ratio. So their earnings per share have really fallen off quite a bit, which naturally makes it a lot more difficult for them to pay their dividend. But if you look at dividends per share at $6.66 and compare that with both my Buffett's free cash flow or owner's earnings and actual free cash flow, you can see that they're still well covering their dividend. Free cash flow numbers are significantly higher than earnings. So I do think IBM is moving in the right direction and comes in at number 21. At number 20, we have healthcare stock Amgen, and this is another one where payout ratio may be a little deceptive. We're showing it here at 113%, and that is compared with earnings per share. So earnings per share here at $7.81 is lower than dividends. However, you're looking at owner's earnings and free cash flow, you can see that the dividend appears to be relatively well covered. So this is penalizing this particular stock. At number 19, we have Travelers. This is also a financial, but it's an insurance company. Still gets unfairly penalized on asset turnover specifically, but these generally don't have preferred stock, and they can, as you can see, historically they have had some preferred stock back here, but now they do not have any. So overall, insurance companies tend to score better in this particular system. At number 18, we have McDonald's, and this is the first one that I would point out a really nice kind of upward trajectory over time. They did have a bit of a hiccup back here in 13, 14, 15, but overall this is nice and consistent. If we look down at earnings, free cash flow, and owner's earnings per share, you can see there is no negative numbers. Anytime you see a company that's been able to be profitable on all three of those metrics and continue to pay dividends for that long, it's generally a very, very, very high quality company. We can also take a look at shareholder yield. I forgot to mention that, but this is included as well. So it's the dividend plus any buyback minus any share dilution. So you can take a look at how much they're returning cash to shareholders over time. And one thing to point out is back in 16, they had a 13%, near 13% shareholder yield. And if we look back at 16, that was when they were buying back a ton of stock, and that was an absolute fantastic time to do that. So just a way for you to assess how well a company is doing at returning cash to shareholders, and not just with the dividend, but also with the buyback. At number 17, we have industrial Honeywell. They score a 59 out of 100. And looking through the numbers here, there's really not a ton that I would point out as being overly positive or negative. This is just kind of a steady Eddie kind of industrial. Next, we have 3M. Now, this is one I think there are some significant problems with. You'll see that the trend of earnings and dividends was generally positive over time, along with price, just like we're looking for. But back here in 2017, you see price started to really come off, and then lately we see that earnings have also collapsed and they cut their dividends. So I would say significant issues here with 3M. And the biggest red flag here, I think, is this cash conversion ratio. So you can take a look at here. This measures the cash flow from operations divided by net income. So basically, how much cash is this company actually generating relative to the earnings that it's reporting? And that has fallen off of a cliff. Generally, you want to see above 95%. It actually got negative in 2023, and now it's still at 30. So this suggests the earnings are actually overstating the amount of cash that they're producing. And if we look at the cash flow numbers, that is the case. They are reporting $7.92 trailing 12 months earnings, but the Buffett owner earning calculation and free cash flow are both significantly lower than that. In fact, you can go back to 2022 and see that while despite them reporting $10.20 roughly in earnings, their actual owner's earnings, as Buffett might calculate it, was almost half of that. So troubling picture from 3M. Next, we have Cisco. This is another one that's pretty steady Eddie whenever you look at the numbers. Nothing super meaningful jumps out, but I will say one thing just visually to see here is that the earnings per share have gone roughly sideways for years. So you can see that's basically been flat, and dividends have really started to slow, basically getting token increases at this point just to keep up the streak, and you have price that started just to go sideways. So overall, this isn't a super compelling picture. Next, we have Walmart. This is one that is pretty compelling. So clearly they had some issues here back when Amazon was kind of eating their lunch a little bit, but I think they've got that figured out, and they're starting to again see significant earnings, sales growth, and their price has gone right along with it, scoring a 65 out of 100, which is starting to get into the quite good territory. Coming down to the metrics, I would say based on my last video, gross profitability ratio is here. This is gross profits divided by assets. If you don't know what that is, I talked about that in detail in last week's video, but this is an extremely impressive number, 63%. This might be the highest on the list. I haven't checked, but this is very, very, very good. Generally looking for anything over 30 as being impressive. Walmart has had over 30, over 50, I think, every year since 2001. So based on this metric, an absolute phenomenal business, and I think indeed it is and still is. Next, we have Johnson & Johnson. Now this is one that's kind of interesting. They've gone through quite a bit of issues in recent years, and you can see that by earnings. So earnings have actually been sideways now going back a very, very, very long time. Their dividend has continued to be increased, but you're starting to get where earnings and dividends are kind of close together, and price has also started to suffer. It still scores a 65, but you can see that the payout ratio here, I've got it turning red. Over 80% I would consider to be a little bit more of a troubling picture on payout ratio. They do have a little more room if you look at owner's earnings and free cash flow, but you've seen a steady deterioration in returns on capital, which, as we talked about earlier, is not something that you love to see. Returns on equity have also fallen from their highs at around 25.5 down to 20. Still quite a bit of green here and quite a lot to like about Johnson & Johnson, but the near-term deterioration is definitely a little troubling. Next, we have American Express. This is also a financial, so they're a little bit penalized by that anti-financial bias, but just a beautiful long-term upward trajectory. Some hiccups, obviously. 2008 and 9 were not pleasant for financials in general, and a few hiccups here along the way, but generally in line point, nice long upward trend up and to the right on everything, which is what you want to see. Nothing super notable to point out here. Payout ratio still at 20%, and free cash flow, owner's earnings, even better than earnings would suggest. So overall, I don't see any major red flags here with American Express. Next, we have Procter & Gamble, another one like Johnson & Johnson, just kind of an American stalwart. Another kind of mostly up and to the right, a little more rolly in terms of earnings, but nice upward trajectory in dividends. They're one, interestingly, that does have preferred stock on their balance sheet. I don't know why they do. It doesn't seem to me like they really need it, but it does get penalized at least 2 points for that. I give 2 points if a company has no preferred stock and 0 points if they do. Finally, getting into the top 10, we have Salesforce coming in at number 10. They just recently started paying a dividend, so you can see that by this green bar. This is one that I've been critical of in the past, mostly because of this shareholder yield being negative. So they didn't pay any dividends for a long time, so you can see that here, dividends per share were $0 going back a very long time, just recently turned positive, but you can see the negative numbers, which suggests that they were issuing a lot of equity, basically to compensate their CEOs or maybe to raise cash. This just recently turned positive, so they're paying a dividend, and they've really pared back on their share issuance, which I really love to see. So overall, I think much positive here in terms of being shareholder friendly for Salesforce, so I like the direction this is heading. At number 9, we have Amazon. They do not pay a dividend, but they easily could. You could see an absolutely incredible growth in earnings and price over time. And if we take a look at their numbers, this is one of the more interesting ones in terms of free cash flow, earnings, and owner's earnings. So for a long time, it was a little bit of a headline, like, why does Amazon do so well? They don't make any money, their earnings are negative, blah, blah, blah. Well, the reality was they were actually investing a ton of money. And so when they're investing so much money for future growth, it makes their earnings look worse than they actually should be. And that's where Buffett's owner's earnings do a really good job of adjusting for that. Basically, the idea is that you have free cash flow, and that is cash flow from operations minus capital expenditures. But not all of those capital expenditures are required. Some of those are for future growth. And so what Buffett tries to do is add back the part of cash flow that's for future growth so that he gets a better idea of what the company is actually earning if it were just to simply maintain its competitive position and not try to grow anymore. And so if you look at that, that's actually been positive every single year going back to 2002. And that is also significantly higher than their current earnings report. Amazon is likely a more attractive earnings picture than they report in their GAAP numbers. At number 8, we have Merck. Taking a look at the numbers here, I don't see anything significant, either positive or negative, to point out. Moving on to number 7 at UNH, which obviously had some tragic news yesterday with one of their CEOs getting murdered. Their stock's off quite a bit today, I think, mostly because of the negative sentiment kind of growing a little bit around health insurers. And so it'll be interesting to see kind of how that plays out in terms of their results. But you do see the earnings have come off a little bit in the last 12 months, so that's a little concerning, but in general, this is a nice up and to the right kind of chart. Everything looks pretty good here, except this cash conversion ratio has come off quite a bit, so you see a significant drop in that is generally not a great sign, so something to keep an eye on here. And their earnings are actually higher than their free cash flow and owner's earnings. You would prefer to see that reverse. At number 6, we have Caterpillar. Now this one's generally up and to the right, but a lot more variability. This is obviously a very cyclical business, and that's reflected in the numbers. You can see that free cash flow has been negative, earnings have been negative, and I didn't shade these red yet, but owner's earnings were negative here. I generally don't look too hard at investing in CAT, but it's done well over time if you're willing to hold it and just be patient in the inevitable ups and downs. At number 5, one of my very favorite businesses, Visa. This is very nicely up and to the right on all metrics. Definitely not growing as fast as it once was, but still a very, very high quality business. This also gets penalized a little bit for preferred stock. It is a financial, so they have a little bit of preferreds on their balance sheet. So if you take that away, it's an even better result. I really like like Visa a lot. Number 4, one of the best, if not the best, retailer in the history of mankind. I guess Amazon's up there too, but Home Depot, just absolutely amazing business. When the housing bubble popped, earnings fell off a bit, but ever since then, just a steady upward trajectory. I think homes are drastically underbuilt, and so I think Home Depot has a very long runway for growth. Just taking a look here at their numbers, overall pretty solid. Coming in at number 3, we have Apple. Not a lot to be said about Apple. Obviously, one of, if not the greatest businesses in our generation. And the numbers reflect that across the board. Just absolutely sensational. A ton of green. So beautiful. At number 2, we have Nike. This one's also generally up and to the right, but very concerning is the last 3-4 years, you see the price really start to come off. We haven't seen that yet with earnings. They have flattened out a bit, but we haven't seen any major deterioration. And we look down through the numbers, and I don't see a ton to be worried about, with the exception of returns on capital dropping from high of 31 down to roughly 21. So that's something you might be a little worried about. You also see their gross profitability ratio coming off from 74 down to 59. So there are certainly some trend issues here, specifically price, and I think some of the fundamentals are starting to soften a bit. I know there's some concerns with this one about China and how they're going to be able to grow and kind of more of a hostile global environment. Number 1, we have Microsoft. This is another one that's just been an absolute up and to the right. And looking at the numbers, you can see why. Green pretty much across the board for them. I don't see a single year where they lost money on earnings, free cash flow, or owner's earnings. Dividends have been growing for a very long time. Virtually nothing to point out here that would be considered negative. Maybe if you can find something, you can put it in the comment section down below. If you're a Patreon or YouTube supporter, go check out the entire list of the entire S&P 500. That's going to take you a while to go through, so hopefully it'll provide some investment ideas for you. Again, this is not a recommendation to buy any of these stocks, just screening ideas, just quantitatively trying to bubble up what may be a good investment and what may not. So thank you so much for watching, and I will see you in the next video.